Welcome one, welcome all to the Dividend Grinder. In this video, we're going to be talking about dividends and taxes and how you're supposed to file if you get dividend income. So the basics with dividends and taxes is there are two types of dividends that can receive. So you have your ordinary dividends, as you see right here, and then you have qualified dividends. So basically, qualified dividends are definitely a better benefit to the person receiving the dividends, but in reality, ordinary dividends make up a majority of what you're going to pay. So ordinary dividends, as you see in this definition right here, are taxed as ordinary income. And all that means is whatever tax bracket you are in, that's the percentage that your dividends get taxed at. But qualified dividends are special dividends in that they get taxed at your capital gains rate. So it can be 20%, 15%, or 0%, as you can see right here. So I'll get into a chart a little later to demonstrate what you would get taxed at for qualified dividends, depending on your tax rate, but let's just go down a little more. So if you get a dividend payment of $10 or more from one entity, you are going to get a 1099 DIV in the mail stating what kind of dividends you received, what percentage of them were ordinary, what percentage of them were qualified, and so on and so forth. As you can see, if you get dividends from special types of corporations, S corporation or trust or estate, real estate, investment trust, stuff like that, you will get, there's actually a little different taxation on those, which I will get into later as I show one of my REITs that got taxed. But long story short, if you got paid $10 or more from a dividend from one company, you are going to have to pay taxes on it. And the big piece that you need to know is whether it is an ordinary dividend or it is a qualified dividend. So let's say it is a qualified dividend. What tax rate do you get taxed at? So if we go back here, there's a nice little chart on the Motley Fool. So here is the rate. So here on the left side is your ordinary tax rate, or your normal tax bracket that you're taxed on. And then on the right side is based on what your ordinary income tax rate is you get your qualified dividends or your capital gains tax rate. So if you make 15% or less, or that's your ordinary income tax rate, you're actually not going to have to pay any taxes on your qualified dividends. So your capital gains tax is actually 0%, which means also if you hold the stock over a year and then you sell it for some profit, you're actually not going to have to pay any taxes on that gain if you make 15% or less on your tax bracket. So that's very tough to do. You need to have a low income, and you're most likely not going to have that many investments anyway if you're having that low of an income, but it is possible, and it's a way to encourage people with less income to hold their stocks a lot longer because they'll get rewarded with a 0% capital gains tax if they hold it for a long time. Now, more common thresholds are right here. So, whoops, we'll get rid of that circle. That's ugly. 25, 28, 33% ordinary income or your tax rate. You're most likely going to get a 15% capital gains tax on your qualified dividends. Again, ordinary dividends are paid at your normal tax rate, while qualified dividends are paid at their capital gains rate. So as you can see, it's 15% all the way until you get to that pretty much 40% ordinary tax, really high income earners. And at that point, you'll still get a decent discount of 20% at your capital gains tax. So let's take a look at one of my examples because there's actually another component that falls into it. So I've made a video previously on real estate investment trusts, and I think it was in my video on the dividends and things to look for. If you are a dividend investor, chances are you're going to look at dividends, you're going to look at real estate investment trusts at some point because they pay high yields because as required by law and by the IRS, they are required to pay 90% of their earnings through shareholders in the form of dividends. So they are quite lucrative, I would say, because they have high yields. However, the stock price typically does not indicate much growth. So let's look at the largest REIT that I own, which is Gaming and Leisure Properties. So they just filed, if we go down to the news here, their 2017 tax distribution tax treatment. So here's exactly what we were talking about earlier. So let's take a look at this top line right here. So this was the dividend paid out on March 24th in 2017. As you can see, the dividend paid out was 62 cents per share, okay? So your ordinary taxable income right here, you're showing on box 1A, 56 cents. So that's, obviously that's a large portion of the total dividend that paid out. So 56 cents out of the 62 cents that was, completely paid out to the shareholders, 56 cents is taxed at ordinary income. And if you look at it, it's actually 0.5698. So it's actually 57 cents. So let's get a little chart going down here. So you got 57 cents that's going to ordinary income. So that's you're paying at your marginal tax rate, whatever it is that you pay, depending on your income thresholds. You're just going to pay your ordinary tax rate on that 57 cents, depending on how many shares you have and what the total distribution is. But 57 times how many ever shares you have, that's what you're going to pay in ordinary tax. You'll see in box 1B right next to it, qualified dividends. So my screen goes dark here. Qualified dividends, 0.013. So you will get 0.01 in capital, which obviously sounds pathetic if you own one share, but if you own multiple shares, so say you own, 1,000 shares of it, well then $10 of that is qualified at least. So it's a little tax break. Box 2 and 2A and box 3 get a little interesting. This is more if you own real estate investment trust, what you're going to experience. So you'll see box 3, it says non-dividend distributions. And it's a relatively small amount. It's 4 cents. But if you go into the definition here, it says box 3, amounts shown in 3 are also known as, if I can get back to it, also known as return of capital. And this is interesting in real estate investment trust. So that piece actually goes against the basis of what you bought the share for. So say simply you bought a share of a real estate investment trust for $20, right? So normally you would be taxed. Normally the cost basis for that stock would be $20. You bought it for $20, there it is. However, with real estate investment trust, this return on capital actually goes against your cost basis. So if you paid $20 for one share of stock, and then you see this distribution here was 4 cents per share, so you have 0.04 cents. Your new cost basis is actually $19.96 per share. So the return on capital actually lowers your payments that you have to do on dividends. That's real estate investment trust. That's a little more advanced in terms of dividend taxing. For the common investor who just gets normal dividends from normal blue chip stocks and so on and so forth, you're just going to have to worry about ordinary taxable dividends, and you're going to have to worry about qualified dividends. And obviously, the higher the qualified dividends, the better, because you'll pay a lower rate. It's your capital tax rate rather than your ordinary tax rate. But in the case of real estate investment trust, you might get that additional benefit of return on capital, which lowers your cost basis. And if you hold the asset for a long enough time, you could actually turn that cost basis into a capital gain, which is very uncommon. However, it can happen if you hold a large amount of shares and the return on capital is high. It can actually turn out to be a capital gain rather than any cost basis at all for the shares. But that's only on real estate investment trusts. Like I said, you're only going to have to worry about ordinary tax and qualified dividends if you are getting normal dividend distributions. So that's a little summary of tax paying on dividends. If you receive $10 or more from dividends, you'll pretty much always have to pay taxes. There's no way around it. But dividends are never anything to hide from just because of the tax payments. I hope everyone enjoyed this video. If you're new to these videos, I encourage you, please subscribe to my channel. I'll be making almost daily. I'm trying to get daily videos out. Saturdays are typically short videos. I call those Saturday shorts. Well, all the videos during the week are typically longer, like this one that I'm doing on Sunday as I'm recording right now. Like the video, and please leave a comment if you have any questions about taxes on stocks or dividends in general, or if you want to see something in the future for me to do a video on. That's it. This has been the Dividend Grinder. Peace out.